Every boom tells the same story. This time is different. Prices only go one way. Don't worry, the government will never let it fail. For 20 years, that was the unofficial slogan of Chinese real estate. Apartments that nobody lived in, ghost cities with lit-up towers but dark windows, families buying second, third, even fourth homes, not because they needed them, but because there was nowhere else they trusted to put their savings. Real estate became China's retirement plan, social safety net, and lottery ticket rolled into one. And then one of the biggest players at the center of that dream, China Evergrande Group, collapsed under more than $300 billion in liabilities. A giant that once sold more apartments than almost anyone on Earth was suddenly facing court-ordered liquidation, its stock delisted, hundreds of projects frozen, and millions of families left, wondering what exactly they had bought into. For years, analysts asked the same question. Will Evergrande be China's Lehman Brothers? That was the wrong question. The better one is this. What does China's Evergrande moment reveal about every country that has turned real estate into a national obsession? Because this isn't just a story about one company failing. It's a red flag about what happens when an entire system builds its future on concrete, leverage, and the belief that home prices can never, ever fall. This is where money, power, and history collide, and nothing is as simple as it looks. Real estate in China isn't just a sector of the economy. For years, it was the economy. Housing and related activities directly and indirectly made up a massive share of China's growth, and an enormous portion of local government revenue was tied to land and construction. For households, the concentration was even more extreme. Roughly 70% of Chinese household wealth is tied up in property, far more than in places where savings are spread between stocks, pensions, and other investments. So when a developer the size of Evergrande goes down, it's not just a company in trouble. It's a crack in the story that ordinary people were told for decades. Work hard, save money, buy property. The system will take care of the rest. To understand how this point was reached, China's Evergrande moment, it's necessary to go back to the beginning. Not to the headlines of 2021, but to the quiet policy decisions that turned land and apartments into the engine of modern China, the rise. When China began its economic reforms in the late 20th century, it needed two things: jobs in the cities and money to build those cities. Local governments were not allowed to levy large, independent taxes the way many Western cities do. But they could do one powerful thing. They could lease land. So a model emerged that would define the next 3 decades. Local governments took rural land, converted it into urban construction land, and then leased that land on long-term contracts to developers. Developers borrowed heavily, built apartment blocks, and sold them to families. The land payments filled local government coffers. The construction created jobs. The apartments became the main investment vehicle for the new middle class. It worked so well that it started to look permanent. Between the early 2000s and the 2010s, urban housing prices in many major Chinese cities soared several times over. It felt like a one-way escalator. People who bought early watched friends and co-workers get priced out. Those who arrived later worried they would be left behind if they didn't stretch every last renminbi to make a down payment. In a society with limited social welfare, underdeveloped capital markets, and strict controls on moving money abroad, one belief hardened into dogma. Cash loses value. Stocks are risky, but apartments are safe. Developers understood this better than anyone, and few understood it as well as Evergrande. Evergrande started in the 1990s and grew into one of China's biggest private developers by doing one thing exceptionally well: turning faith in housing into upfront cash. The company mastered the pre-sale model. Instead of building first and selling later, it sold units years in advance, collecting deposits and mortgage funds from buyers long before the buildings were finished. That money went into acquiring more land, starting more projects, advertising more aggressively, and even branching out into side ventures: electric vehicles, theme parks, bottled water, a professional football club. On paper, it looked like unstoppable success. In reality, it was a classic debt spiral. Evergrande was borrowing from banks, from bond markets, from shadow financiers, and from its own customers. By 2021, its liabilities were estimated at over 2 trillion yuan, making it one of the most indebted developers in the world. Investors reassured themselves with 3 comfortable words: too big to fail. The logic was simple. If Evergrande went down, so would confidence in the entire property market. Local governments would lose land revenues. Banks would face rising bad loans. Households would lose life savings tied up in half-built apartments. So the thinking went, the authorities would have no choice. They would step in and make sure the giant stayed standing. History, as usual, had other plans. In 2020, Chinese regulators looked at the mountain of developer debt and decided the party had gone on long enough. They introduced what became known as the 3 red lines: financial thresholds on leverage and liquidity that property companies had to respect if they wanted to keep borrowing. In simple terms, the rules said that total liabilities could not exceed a set share of assets. that net debt could not be greater than equity, and that a company's cash had to at least cover its short-term debt. Meet all three lines, and borrowing could still grow, but more modestly. Cross them, and the walls would start to close in. Evergrande didn't just brush against those lines, it barreled through all three. For a while, the company tried to dance faster. It sold assets. It offered steep discounts on apartments. It leaned on pre-sales even harder, pulling tomorrow's demand into today's cash flow. But in a system where every player has borrowed from the next, there's always a moment when the music simply stops. In 2021, Evergrande began missing bond payments. Offshore creditors found themselves sitting on IOUs that no one at the company seemed able or willing to clearly explain. Credit rating agencies eventually declared it in default. The fear, especially outside China, was simple. Is this China's Lehman Brothers? Would the world wake up one Monday to discover that a property developer in Shenzhen had triggered a global financial crisis? Again, that was the wrong question. China does not run its financial system like the United States. It does not typically let big players fail quickly and loudly. It prefers something else, controlled demolition in slow motion. As Evergrande's debts came due, the priority was not saving investors. The priority was preventing chaos among homebuyers. Those pre-sales mattered. Millions of families had paid for apartments that did not yet exist. To them, Evergrande's balance sheet was not an abstract financial problem. It was the difference between having a home and watching their savings evaporate into rebar and dust. There was no dramatic national bailout with triumphant press conferences. Instead, the response was quieter and far more surgical. Local governments leaned on healthier developers to take over unfinished projects. State-owned firms quietly bought land banks or assets at steep discounts. Banks rolled over some loans and tightened others. Regulators signaled again and again that home buyers would be prioritized and that foreign bondholders would not. The process was messy. There were protests. Construction delays dragged on. Some projects were abandoned completely. But there was no single Lehman moment, no globally contagious chain reaction. Instead, what emerged was a long bleed. After years of stalled restructuring attempts, courts finally ordered Evergrande to be wound down and liquidated. Liquidators were appointed. The company began being dismantled piece by piece. Its shares disappeared from stock exchange screens. For the global financial system, it was not a sudden heart attack. For China's real estate dream, it was a slow, unmistakable stroke. Prices across many cities fell back from their peaks. Land sales, once a fire hose of money for local governments, shrank sharply, blowing holes in local budgets. Developers that once looked invincible became case studies in what happens when a model built on endless growth meets demographic reality, stricter rules, and a generation that is no longer willing to believe the story. So what, exactly, is the red flag here? It isn't simply that one giant company failed. It is that the assumptions behind the entire boom were always fragile. And those assumptions are not unique to China. History tells a familiar story every time a society falls in love with real estate. In 1980s, Japan, land prices in Tokyo became so inflated that people joked the imperial palace grounds were worth more than all the real estate in California. Banks lent freely against rising collateral. The stock market soared. Then the bubble burst. Land values collapsed. Decades of lost growth followed. In the 2000s United States, the story wore different clothes but followed the same plot. Easy credit, rising home prices, mortgage-backed securities that turned suburban houses into global assets. Experts reassured the public that real estate never falls everywhere at once. Then it did, and the 2008 financial crisis was born. China's Evergrande moment fits neatly into this lineage. Every time a simple emotional truth is weaponized into policy, people feel safer owning something they can see and touch. So politicians quietly encourage it. Banks monetize it. Developers industrialize it. And one day, the very thing that felt safest becomes the epicenter of risk. The red flag is not Evergrande's name on a court document. The red flag is when an entire economy, and the majority of household wealth, rests on one asset class whose price must keep rising to preserve social stability. That is not a home. That is a pressure cooker. Zoom in on Evergrande's balance sheet and it looks like a corporate disaster. Zoom out and it looks like something else, a wealth transfer mechanism breaking down in real time. During the boom, developers borrowed cheaply, bought land, and sold apartments at ever higher prices. Local governments pocketed land revenues, banks collected interest, investors earned returns, ordinary families took on huge mortgages, convinced that even if the debt felt heavy now, future price appreciation would justify the sacrifice. When the music stops, the question is simple: who is left holding what? Bondholders can launch lawsuits in foreign courts. Banks can restructure loans and write off losses slowly over years. Local governments can lobby the center for support and search for new sources of income. Homebuyers stare at empty construction sites and mortgage bills that still arrive on time every single month, whether or not their apartment is ever finished. That is the uncomfortable pattern history keeps revealing. In every real estate meltdown, from Florida in the 1920s to Japan in the 1990s to America in 2008, the people who believed the loudest, who stretched themselves the furthest, and who took on the most leverage tend to pay the highest price. China's twist is scale. When roughly 70% of household wealth sits in property, and when real estate and its satellites have been a key pillar of GDP for years, a slowdown is not just a sector correction. It is a psychological shock. It tells millions of families one thing. What felt like a guarantee was, in reality, a bet. So what survives when a real estate model like this comes under strain? Not the slogans, not the glossy sales pitch, not the promise that prices will never be allowed to fall. What tends to survive are the same things that have outlasted every financial storm in history. Real, productive assets that generate income instead of relying on sentiment alone. Balance sheets that are not stretched to the breaking point. Liquidity and flexibility that allow people and institutions to adapt, to buy when others are forced to sell, or simply to wait. Skills and capabilities that are valuable across cities, sectors, and cycles, rather than identities built entirely on owning one more apartment. In China today, a quiet version of a very old story is playing out. Developers that overreached are being dismantled or absorbed. Owners of multiple investment departments are watching rents stagnate and resale values soften. Young people, facing high unemployment and lower expectations, are increasingly unwilling to lock themselves into 30 years of debt just to follow a script their parents believed in. At the same time, those who held back, who rented longer, who diversified their savings or invested in their skills instead of in speculative property, found themselves under less pressure and with more options. Collapse is not always a dramatic crash. Sometimes it is a long, grinding recognition that the old rules no longer work. This is where China's Evergrande moment stops being a purely Chinese story and starts becoming a mirror. Because almost every country has told some version of the same fairy tale. In Canada, Australia, parts of Europe, and in major cities across the United States, property prices have soared far beyond local incomes. Governments talk about the dream of homeownership while quietly relying on transaction taxes, property taxes, and construction jobs to support budgets and employment. Banks package mortgages into seemingly sophisticated products that all rest on a single assumption, that enough people will keep believing. China is not unique in turning real estate into a national obsession. It is simply the latest and the largest to hit the point where the math refuses to cooperate. A shrinking population, slower urbanization, years of overbuilding in smaller cities, piles of unfinished apartments, a generation that no longer sees property as a guaranteed escalator to a better life. All of these forces are converging to force a reckoning. Evergrande is the symbol, not the cause. Its fall is a red flag waving over a much bigger structure. A system that confused rising prices with real wealth, that treated concrete as a substitute for a pension system, and that tried to build a sense of security on top of an ever-growing tower of leverage. History suggests something very different. The lesson is not that one country is doomed, or that real estate is inherently bad. The lesson is that whenever a society concentrates its wealth, its hopes, and its policies into a single asset class, whether it is tulips, tech stocks, or tower blocks, it is time to start asking hard questions. What happens if prices stop rising? What if the players assumed to be too big to fail are allowed to fail slowly instead? Who is quietly being asked to absorb the losses when the story no longer sells? China's Evergrande moment is not a sudden jump scare. It is a slow, grinding wake-up call. For China, it signals that the old growth model of building more, borrowing more, and selling more apartments is running out of road. For the rest of the world, it is a reminder that no matter how confident the slogans, no matter how solid the concrete looks, a home is never just a home. It is a node inside a web of incentives, debts, and political decisions that can, and do, change. The illusion is that real estate is the safest possible bet. The reality is that safety never comes from an asset alone. It comes from understanding the system that surrounds it, and from refusing to believe that this time is different simply because so many people desperately need it to be.